Welcome to Geojit Spotlight. After the recent state elections results, the financial markets have witnessed a notable surge. Today, we delve into the current market assessment, exploring the factors driving this rally and addressing potential risks. Geojit Chief Investment Strategist Dr.V.K Vijayakumar joins us to share his views on current market scenario. Welcome, sir. The crucial state elections results have sent a clear message. The markets have reacted. Nifty and Sensex are at record highs. How do you assess the market now?
Yes, we had a super Monday on December 4th when the Sensex delivered 1,383 points rally and Nifty delivered a 418 point rally. The market was responding to the big event. From the market perspective, the election outcome was better than expected. Now, if you look at the history of elections, the pre-election rallies, you take the last 5 general elections in India, 1999, 2004, 2009, 2014, 2019. In all these 5 general elections, the market started rallying in the run-up to the elections. So rally begins around 5 to 6 months before the elections, and after the elections we will have a rally only very rarely, like in the year 2009 when the UPA came back to power without the support of the left. That was not expected, and therefore after the elections the results were declared, the market one day we had 2 circuit breakers at the index level. So that happens rarely. Normally the market will start rallying in the run-up to the elections, and after that there will be a period of consolidation. So what we are witnessing now is a pre-election rally. Now, a very, very important point that we have to understand is the market does not have any preference for any political party. I told you in UPA too, when it came back to power, there was a big rally in the market. Market wants political stability. The market likes a reform-oriented, market-friendly government. Now the market is expecting that from the present ruling party. And it appears likely, of course, it is very difficult to predict political events. It can change very fast. But if you go by the present trends, it is quite possible that the ruling dispensation will come back to power. So the market is discounting that political stability. And what makes this rally very strong is that this expectations of political stability is being supported by economic fundamentals. There are very good news from all around, from the economic perspective. India's GDP growth in the second quarter came at 7.6%, much higher than the consensus estimates. Inflation has come down to 4.87%. So the RBI will be very happy about that. The rupee is reasonably stable. And more importantly, the Fed, the American Central Bank Fed, is likely to pause. They have reached the end of the rate hiking cycle, and therefore the US bond yields have started coming down. The 10-year US bond yield touched the 5% in mid-October. Now it is only 4.25 basis points. There is a sharp 75 basis point cut in the US 10-year bond yield. Consequently, foreign portfolio investors stopped selling and they have turned buyers. So DIIs, retail investors, HNIs, and now foreign portfolio investors also are buying. So this rally has the technical support of political stability and expectations surrounding that, plus very strong economic fundamentals.
Sir, how long will the rally last and how far can the indices go?
Well, that's a very difficult question. Nobody can predict how the market is likely to behave 1 month from now, 2 months from now, 3 months from now. Therefore, you can't say how long will the rally last. Of course, this is the beginning of a pre-election rally. It can last for a few months. And presently the Nifty is around 20,600 levels. There can be another 5 to 6% rally in the Nifty and the corresponding rally in Sensex also. But a sustained rally for the next 3 to 4 months before the elections is an unlikely possibility.
What are the risks and what should be the investment strategy?
Well, talking of risks, there are always known risks and unknown risks. Unknown risks, nobody can say anything about it. There are 2 wars raging in the world, right? The Ukraine war is still on, and we have the Iran-Hamas conflict. So that is the unknown part. We don't know anything about that. The known risk is the valuations. The one reason why I'm a little bit concerned about the continuation of the rally is, beyond a particular point, is that valuations are already high. Now Nifty is trading at 20 times, more than 20 times FY24 earnings. The other indicator of valuations, the so-called Buffett indicator, that is market cap to GDP ratio. Fair market cap to GDP ratio is 100%. Now it is 120%. So valuations are high, and therefore if the market goes up by another, let us say, 5 to 6% in the coming weeks, the valuations will certainly get stretched, and that will invite institutional selling in the market, pulling the market down. So that is the only known risk in the market now.
Thank you, sir. Thank you.